Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, another video on option trading, how some option trading can be applied to precious metals miners, and some of the interesting possibilities that are out there. And we will even break it down into how you can back out some numbers and look at the options as a bit of an insurance policy should there be a big move in metals, with some interesting payouts. So before we get started, quick disclaimer, this is not legal, personalized financial advice. I'm describing a trade that I have been doing over the past decade, something I'm currently doing. Certainly this is in the category of speculative. This is not the same as investing in gold or silver, bullion, which would be a much more conservative thing to do. So I'm not recommending anyone do this. I'm just sharing something that I do and think will be of interest. If you decide to do something similar, by all means, do your homework, do your due diligence, and make sure you understand the risks you're taking. But again, I'm just sharing something that I do that may be of great interest. So with the disclaimer out of the way, as you can see here, I've pulled up the option board for First Majestic Silver, which currently trading at $5.25. And what we're going to be looking at here is based on the premise that I've been studying silver. Again, we hit $49 in 2011. A lot of evidence that the price has been manipulated lower by selling a lot of short paper, of which I don't believe there's the physical metal to back that up. So that's a big part of the premise I'm working on here. You may or may not agree with that. So again, I'm just going to use that example for now. Although this could be used for any asset, not just gold and silver, but today that's what we'll be looking at. So quick way of thinking about it, again, back in 2016, silver went from $14 to $20, and over that same time period, First Majestic Silver went from $3 to $18. Given that some of the miners offer leverage on the actual move in the bullion price, there you saw silver go up $6. First Majestic went up $15. So I wonder if we should hit $50 silver, what would the price of First Majestic be? I've asked a few different mining analysts, also thought about this a bit myself. Certainly if you have $50 silver, even if it went up roughly 1-to-1, you would have around $50 First Majestic. If it went up more than 1-to-1, the numbers could get bigger. Again, there's a lot of room to debate what that price would be, but based on those parameters, again, you may have your own, and you can put in any numbers you want. Doesn't just have to be what I'm looking at here. But let's take a look at how that would work out. Because a trade I actually did the other day, as you see, I'm going to look at the April expiration here. So today I'm recording this January 18, so April 19, 62 trading days, about 3 months away. And you can see that the April 9 calls are being offered at a nickel. Again, if you're new to options, new to calls and puts, I did do another video where we dig more into some of the basics. So link to that is below. May want to watch that one first if you've not already seen it. But with that said, and maybe you're pausing this and coming back now, we will go forward. Because here I have pulled up my option pricing sheet, which if you'd like to contact me, I'd be happy to send you. Quick guide, you can change things in green. Formulas are in blue, so you leave those. But let's say we're looking at that April 9 strike. It was offered at a nickel. Let's say for a moment it was offered at a dime. So you paid a dime to buy the First Majestic April 9 strike. 100 contracts comes out to $1,000 because each contract covers 100 shares. So if you had an explosion in the price of silver, let's say First Majestic, to keep the numbers simple, we'll use 49 instead of 50, which means the 9-strike call, the intrinsic value would be $40 because you've paid a dime for the option to buy stock for $9. So you can buy it at $9, sell it simultaneously at 49, and your intrinsic value would be $40. Simple way, if you take 40, divide it by a dime, you will get a 400 to 1 multiple. So if these conditions played out as described, and you invested $1,000 paying a dime on the April 9 line, your $1,000 would become 400,000, a 400 to 1 multiple, which is obviously quite large. Again, we're talking about, in this scenario, an incredibly large move in the price of silver, which based on this pricing, most of the market is not expecting. I would also assert that most of the market is not looking at the US debt loads or any of the dynamics in silver, which is what makes this so interesting. And again, I'm just sharing my opinion. I'm not telling anyone else what to do, but I believe there's not just a chance that silver will get back up to the $50 range, but that it's an inevitability. So that makes this trade rather exciting to me. Although there's another way that you can look at it, is that, let's say, rather than saying silver First Majestic's going to hit $49, let's say there's only a 5% chance of that, and then a 95% chance that your option expires worthless. Keep in mind that if you're doing anything like this, you are facing a decent risk that your options will expire out of the money. If they do, you can lose the entire premium you paid for that option, although I will get into some ways to look at that. But again here, now we've changed the parameters a bit so that there's only a 5% chance of the big move and a 95% chance of the options expiring worthless. Yet you can see that your investment still ends up being worth $20,000 that you're paying $1,000 for. And the way that works out is that 5% of the time you'd be paying $1,000 and you would come back with the 400,000 under those numbers. Whereas the other 95% of the time you would be getting 0. So essentially, if you made this trade 20 times and your distribution is right, you'd pay 20,000 because each time you're investing 1,000, and 1 out of those 20 times you would get the 400,000 outcome. So if our math is correct here, we will see again, we get that 20-time weighted average multiplier. So really, even if you think there's just a small chance that you have that big move in silver, you can see the numbers are still quite a bit in your favor. Although let's take a look at what it would look like without such a big move. Again, silver went from 14 to 20 in 2016. First Majestic went from 3 to 18. So let's just say you had a decent rally in price of silver, which left First Majestic at its 2016 highs of $18. And if we say, look at those numbers, so still even just reaching the high of 2016, if that were to happen, your $1,000 becomes $90,000. And the way this gets so big, again, is that you're paying a dime for something that becomes worth $9, which is how you get that 90 to 1 multiple. Now, certainly, if one of your questions is, well, how do I know this move will happen by the end of April expiration, which is 3 months away? Well, certainly you don't. I don't. Although, as I mentioned earlier, you can look at this similar to how you might an insurance policy on something. So again, let's say we're looking for that $49 move, which give us the 400 to 1 multiple. So essentially, you'd pay $1,000, and for the next 3 months, you'd have an insurance policy in place that if you get the big move, whatever it goes to, you get a nice payout on your investment. So conceivably, with these numbers, would be 400,000. Now, let's say that that doesn't happen in 3 months. So assuming the pricing is relatively the same, and you rolled over that policy for another 3 months, so you paid another $1,000, and you could essentially keep doing this. So if a 3-month period cost you $1,000 to insure, then you're looking at $4,000 to cover you for a year, because then you could just consistently have this policy on. So now for $4,000, if there's a big move in silver anywhere over the next year, then again, you're covered and would be able to hit your multiple or whatever assumption numbers you put in there. Although what is interesting, again, you remember that those April 9 calls were actually offered at a nickel. And I want to show you what happens, because it sounds like the difference between a nickel and a dime, not that much. Yet if you pay a nickel instead of a dime, that means for your same $1,000, you can get twice as many units. So now you're paying a nickel, so you can get 200 contracts, which means that should you have that same scenario, now you're looking at 800,000 to your 1,000. So essentially, you've cut the price of your insurance policy in half. Maybe another way of looking at that is, again, let's say you only spent $500 because you're getting those options for a nickel. You still get that same payout, but you've spent half as much. So now you've spent $500 for the 3-month period, which means that if you wanted to roll that over for a year, now you're looking at 2,000 instead of 4,000. And so let's say you wanted to do that for a 5-year period, means that for 5 years, for $10,000, you could have this insurance policy in place that would cover you for that entire period. And certainly for the folks who do believe that silver prices are manipulated and there's going to have to be a snapback at some point in time, I would say, and at least what I'm doing with my trading, is that, yeah, I'm happy to have that. Pay the 500, pay the 1,000, or whatever amount you put in. If it happens during the first expiration, fine. If it doesn't, then you just roll it over. And perhaps one way of thinking about it, imagine you had a $100,000 portfolio and you took 10%, put it into this trade. So you'd still have 90% of your capital to diversify into other areas. And then if you have something that, in my opinion, is likely to happen, certainly pretty likely in the next 5 years. In fact, again, let's look at the smaller example. Let's say First Majestic just went to 18 over the next 5 years. So again, if you're paying 10,000 for 5 years of coverage and you ended up with 90,000, you'd still be well ahead, even if you invested the rest of your portfolio in cash, let alone if you put diversifying investments in the rest there and they do well. So again, the point is that with some of these call options, if you think there's a move coming in the price of silver, obviously this works for gold. You can also use this same concept if you think other assets are going down. It's still, the concept applies anywhere, but especially if you think there's a big move coming somewhere where the market is not, then if you use options in a well-structured way, you can really give yourself a great insurance policy on something that's likely to occur for a really cheap price. So anyway, I'm going to stop here for now. I know I went over a few things, but hopefully this all makes sense. You can leave any questions below. Look forward to hearing those. If you would like a copy of this option pricing sheet, you can do so. I'll also put the contact link there as well. And again, keep in mind, this is not a conservative trade. This is very speculative. My background was as an options trader, so have experience and have done this before. And certainly for anyone who wonders if these numbers are far-fetched, the last thing I'll mention is that back in 2011, did have call options on GLD and SLV when the price was running up. And certainly during that period, the value of my positions went up quite a lot. When the metals got hammered back down, obviously those positions went down a lot. And then over the next 7 years, when metals have been lower, obviously that trade hasn't worked well yet. If you can structure the trade in a way that gives you the advantage of time, and there's something that you believe necessarily must occur at some point, then certainly something really interesting to look into. So with that said, hit the subscribe button. Appreciate you watching. Hope you found this helpful, and I will talk with you again soon.